Well, how the turntables have turned.
Well. How the turntables...
Just 10 minutes ago, the entire investing world was long capitalism, and now they're bullish on communism. Absolute tosses. This is the same switching up your ex-wife did. This is the same switching up Nintendo did. Get it? But on this channel, we don't switch up. We're gonna keep rocking the same raw, unfiltered analysis so you can make money. And just for the record, I was bullish on China before all of the tosses and ex-capitalists turned commies. So go follow me on Twitter because I post so much alpha on Twitter, and let's go make some money this week. Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button, and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500, and Wall Street closed September in a winning month. US stocks sort of just drifted higher after a wild start to the week in Asia. China soared, Japanese stocks tumbled, and that left the S&P 500 in a very weird place. We saw a lot of volatility in our market today. However, we finished in the green with Apple, one of the best performers in the S&P 500, up 2.24% on some upbeat iPhone 16 news and the availability relating to that. The market very upbeat on that. Microsoft gained, Google, Meta gained. Nvidia was sort of flat and semiconductors were flattened down. Software very mixed, as well as the discretionary space very mixed, but Amazon led the flows to the downside, making the discretionary space the worst performing sector, along with materials down 0.2 and 0.5% respectively. Consumer staples was largely flat on the day, and every other sector did gain. The best performing sector, real estate, energy, healthcare, industrials, utilities. So broadening out continues to happen in the end of the month here. I guess you could call this end of month, end of quarter window dressing, and the same type of price action was reverberated throughout the market. Growth core value, small, mid, and large all gained, except in mid-cap core. They were actually virtually flat on the day, down 0.02%. But other than that, it was fairly even trade across the board. People were buying growth, people were buying value across the factor and size spectrum. And today's price action was partly thanks to the moves we actually saw globally. We saw China up very big. It continues the rally on the back of its stimulus, as well as some upbeat economic data we got today. However, most of Asia was actually very red, including Japan, and this saw the European stocks fall as well. This was also on the back of some economic data we got from Germany. The German economy is really slowing. A lot of things happening in Europe that's not good for Europe at all. That's why we had a very mixed trade globally, and that's why we also saw a lot of volatility in our market today. I mean, we were up for the day in early morning trade, then after Jerome Powell came out and had his speech, we actually fell, and then we paired all of those losses to actually finish up on the day with the S&P 500 up 0.38%, the RTY up 0.18%, and the Nasdaq 100 in the middle up 0.22%. And pretty much this volatility that we saw here was brought on by Jerome Powell. After his comments, he came out and he said that he expects only 2 rate cuts of a 0.25 percentage point each year. Traders were actually betting on a 53% chance that we were going to see a 50 basis point rate cut in September, and this was just on the back of the economic data that we've received in the last couple of weeks since the Fed cut rates. And pretty much Jerome Powell said this is not a committee that feels in a hurry to cut rates quickly, simply because the economy is better than expected. Why would they keep going with 50 basis points worth of rate cuts? They can give themselves some dry powder in the future if they go ahead and just cut 25. The market was expecting 50 and 25, and that's why we saw this volatility. But we shrugged that all off because behind all of those comments was stronger economy, stronger retail sales, stronger GDP. And that's why rate cut expectations went from 50 basis points and 25 basis points in the next 2 meetings to 25. And today's volatile trade capped off what was a pretty good month in September. Similar to what we saw today, we saw quite a lot of volatility in the early part of September in the first week, but equities put in a bottom and rallied into into positive territory. The best performing index this month was the Nasdaq 100, gained 3.76%, very, very solid in the large cap, mega cap technology space. The RSP up 3%, the S&P 500 roughly the same as well. Small caps gained as well. Bonds were the best performing asset class into the middle of the month and actually finished the worst performing asset class of the major indices. And this marks the 5th straight winning month for the S&P 500 and the 4th straight winning quarter for the S&P 500. And we've had a spectacular quarter. The best performing index this quarter was the RSP, up 9%, a clear broadening out, followed by the RTY up 9.98%, then the Dow Jones 8%, TLT, and then the S&P 500, which gained 5.49%. That's a very, very healthy quarter. The worst performing index is the Nasdaq 100. It gained 1.88%. So yeah, a lot more alpha generated in the broader economy. I do think that's going to actually continue to play out into the rest of the year. You definitely still want exposure to tech. If you do zoom out, look over the last year, 2 years, even 5 years, momentum is on the side of tech stocks, but we are starting to see a broadening out in the market, and we're starting to see that reflection in earnings as well. But regardless of everything we've seen, guys, this quarter has been a very solid quarter. Nobody else can tell you different. And after today's trade, we saw the S&P 500 finish up 0.42%. The Nasdaq gained, so too did the IWM, the RSP, midcaps, the SP 600. Every major equity index did gain today, as well as yields. Yields gained on the back of Jerome Powell's comments, and so too did the dollar. The dollar up 0.35%, still finding support at this $100 area. And as a result of all of the price action we saw in the dollar and the economy, gold fell, silver fell, commodities as a whole fell. It really was a day for stocks, and they just keep powering ahead. Kind of crazy when you think about it, that at 5,700, a half a point gain on the back of Jerome Powell's comments, which were to some degree hawkish, but hawkish in the context of what the market was pricing in. Regardless, the S&P 500 monthly chart looks very, very strong. This is the monthly chart right here, and you got like 5 straight months of gains, excluding this red month in March. You got like pretty much 12 months of gains in a row, pretty much from this October low we made all the way to here in September. 11 months of straight gains, except 1 month which was red. Very strong, higher highs, higher lows, and a new all-time closing monthly high. We've never had a higher monthly close in the S&P 500. 57.55. Very strong, very, very strong. However, if we do zoom in, there is a couple of things that should concern us. Firstly, these wicks right here. This is telling us that bears definitely did come and cause some volatility in the month of August as well as September, and we're going to see what that looks like in October, because in an election year, October tends to be very, very volatile, particularly the first 3 weeks of October, and that's the month we're going into. So guys, these types of wicks can be an ominous sign, because we actually haven't seen that type of wicks and that type of price action in a very long time. So that is a bit concerning. However, bulls have bought the dip in every single scenario, and I would say that on a monthly chart, until we actually go ahead and break sort of this level right here, the same level where we held resistance in 2021 and use as support right here, until we actually go ahead and break this level to the downside, I remain constructively bullish on the S&P 500. And this right here is sort of at the 5,000 level. That's sort of like the line in the sand where things start to look grim for the S&P 500. Then you can start targeting levels like 4,100 here, these October lows, and potentially the 3,400 area, the 2021 lows. But you first have to sort of break this 5,000 level, and I just don't see that happening right now. It's a very, very big drop to go from where we are right now, new monthly all-time highs, to that area. The market needs to fall 14% for that to happen. And even then, it's going to be very hard for the bears to actually go ahead and break this level to the downside. And very likely we find support here and then continue the move to the upside. However, that is the line I'm looking at. It's sort of like the 49.50. Let's just call it the 5,000 flat level. But looking at the weekly chart, things become a little bit more nuanced. A very similar situation, higher highs, higher lows in the context of new all-time highs. And there's not much to say about this chart either. Very similar to the monthly chart. I would say the weekly bull-bear zone is the 52.91 area. I remain constructively bullish on the weekly chart until we get to this level. we should find support here and move higher. But if we do break below the 52.91 area, that's when we can start to say, hey, the 5,000 level comes into play. But until we actually go ahead and break this, and I would say have a solid weekly close, we didn't have a weekly close right here, have a weekly close below this line and some price discovery on a weekly basis below the 52.91 area. Until that happens, constructively bullish on the S&P 500, and we should go ahead to make higher highs, higher lows, even if we do go ahead and break this low right here. Ultimately, this is the zone that we really want to hold because we use it as resistance right here. We had a bit of price discovery right here. We had a massive wick at this zone. So the 52.91 area, maybe call it the 5300 area, is really where we can start to become bearish on a weekly chart. But again, until we actually go ahead and break this, we remain constructive. And looking at the daily chart, we actually use our options level, our gamma flip, put support and call resistance zones. And we actually saw quite a lot of movement across all of the major indices. The S&P 500 moved up from the 5650 to the 5675, but the biggest move was to put support going from about the 5400 area to the 5600 area. So into the September month, seeing a bit of volatility compression. In other words, the put support moving closer to the gamma flip. And this is just indicating to us that in this new month, a lot of bears have rolled their options to the new month, to the new expiration. And that's why we're seeing quite a lot of movement here in the put support. If we actually go ahead and look at the VIX, down 1% today, but it was actually up significantly in the early morning part of today's trade. You can see, look at this candle right there, a big wick at the top. S&P 500 very, very constructive, but not a lot of room to run down into the support area yet at 56.75. So if bears take us to that gamma flip zone, bulls need to put in a lot of work to hold. Otherwise, we could see very, very quick and sharp downside to the 5600, assuming the put support doesn't move, and not that much upside after today's huge run. I mean, on a peak to trough basis, the S&P 500 really did have quite a volatile move. This is actually called a bullish engulfing candle, but only up 0.42% here for the day. A little bit of upside to the 5800 area, so we can actually see a little bit of upside. And then if we do get there before OPEX, we should see asymmetrical downside. That's how we generally play these levels. So I am a buyer of dips, seller of rips. We are in positive gamma. You don't really want to fight the trend at these levels, but also pay attention to the macro, because that's what can really decouple these levels for the most part. Looking at the Nasdaq, we did see the gamma flip move up from the 19,100 area to the 1945, and we also saw this move up to the 18,750 area. The call resistance didn't move up as well. So a lot of bearish bets getting rolled off in these charts, but not bullish bets getting added to the market. So the market not really liking the risk to reward, especially on the bull side when it comes to the options market. And that's why we're seeing the put support move up, but not the call resistance. But the gamma flip moving up as well is somewhat bullish to a degree. Looking at the RTY, the similar situation from 2175 to 2200, the gamma flip zone. And again, very similar to the S&P 500, we're seeing a lot of volatility compression between the put support and gamma flip, and not a lot of downside here. So bears do take us to this point. Bulls need to put in the work. Otherwise, it's a very quick and short, sharp drop to 2150 put support. So very, very critical heading into this NFP data, heading into the new month, heading into the new quarter. If we slice through these levels on the S&P 500 and the RTY, we could really see short, sharp declines, particularly in this volatile September month. So do be prepared for volatility, guys. But on a technical basis, if you look at the monthly charts, if you look at the weekly charts, things look very, very constructive. And sort of this daily noise, if you are an investor, just ignore it. Buy the dips at those key levels and then just sit through the volatility, because the end of year run is coming. And once we just get the election out of the way and sort of some of these early rate cuts, and then we go ahead and get a clear view on what the Fed's path is going to look like in 2025, particularly towards the end of the year, the market should brush off all of the volatility and move higher from there. And looking at seasonality, guys, this is very interesting. It's S&P 500 performance after we have one down month and then 5 up months. So that's the pattern. What are the returns? 1 month, 3 month, 6 months thereafter. We've seen 29 instances of this. We clocked the 30th instance here in September, because we had 1 month down here in March, and then the remaining months were up. And generally speaking, this is very, very positive. 12 months later, 12.81% return. Very, very strong returns from here. 27 wins, 2 losses. And you actually see we get very linear returns. 1 month later, 1% return on average. 3 months later, 2.61% on average. 6 months later, 6.20. So very linear returns we see when we get this type of pattern. So guys, just a little bit of history and seasonality as we go into this October period, because October can be very volatile, particularly in election years. Looking at just a basic election year seasonal pattern, you can see that from the September into this October period, we generally do see declines, which can be pretty vicious, particularly in this October period. So everything from this red square to the right onward, you can see that we normally move down significantly into the end of August, where we do find a bottom and then move up from there. And we don't just move up into August, we actually move up for the rest of the year into November, into December. So guys, we are looking for opportunities to get long in the next 4 weeks for this end of year run, because the fundamental picture and the economic picture is sound. We have rate cuts on the table, so we want to get long for an end of year run. Diving into sentiment, this is Goldman Sachs sentiment indicator. It just measures stock positioning across retail, institutional, and foreign investors versus the prior 12 months. And you can see that investor positioning has been on a decline through most of August and September, but we have seen a significant rebound in recent weeks. And while we have seen a rebound, we are still not in stretch positioning, neither light positioning. And this is telling us that we are seeing retail, institutional, and foreign investors come back into the market after a volatile August and September. They're probably feeling a bit better after the economic data we got last week, as well as the earnings picture. Earnings, yes, is decelerating, but you have to understand that this is still a growth over the same quarter last year. And what we're seeing from the third quarter, fourth quarter, and into 2025 is a very robust double-digit growth, except here in the third quarter. From the fourth quarter onwards, the other 493 see 12%, 12%, 11%, 13%, and 12% growth, double-digit growth. The Magnificent Seven see mid to high teens growth all throughout 2025. And do I think these estimates are rosy? Yes, but I think we're going to come at or around those levels. But the main thing to look here is from the second quarter and third quarter onwards, we will see the other 493 earnings expand and broaden out and follow suit along with the Magnificent Seven. And that's what a strong fundamental market is based on. Not just a few stocks growing their earnings and rallying, but the broader market doing the same. And while it doesn't have to be one for one, as long as there's double-digit earnings growth, stocks will do very well. And as we see these earnings projections broaden out, the market has actually priced that in. Since June 2024, we've seen the other 493 catch up to the gains in Nvidia. Nvidia has accounted for 4.4% of the 20.4% gain in the S&P 500, but that is pretty much unchanged since June right here, whereas the other 493 have actually seen their gains increase from the same June period into the end of September. And this literally provides a strong foundation for the upcoming bull market and really goes to the broadening out picture we're seeing. At the same time, we're seeing sector and stock correlations at all-time highs. Now, this chart right here shows the average correlation between stocks and sectors over the past year. This blue line represents sector correlation. It has been trending higher. This means stocks within the same sector are moving more closely together. Meanwhile, the black line representing stock correlation is roughly doing the same thing, meaning sectors and stocks are becoming more intertwined to each other, offering diversification opportunities. And this is probably bad news for stock pickers because it means there's less potential for outperformance in individual names because stocks and sectors are roughly producing the same returns. But this is often the type of price action we see in bull markets. And something else we see in bull markets is margin debt following price. This is something we're not seeing right now. Have a look at the year 2000. Margin debt followed the S&P 500 very closely. The same in 2008 and the same here in the year 2021 when we had the everything rally most recently. This, however, is not the case in 2024. The S&P 500 is rallying. Margin debt has not followed suit, meaning there's plenty of gas left in the tank. And I think this right here is going to increase as we get further rate cuts into 2025. And this is a huge tailwind for the market because market peaks often coincide with very high margin debt. Diving into the macro, this is BOFA's GDP tracking estimate. Third quarter GDP estimate is down 0.2 to 2.3%, while second quarter GDP came in at 3% quarter over quarter after the final official estimate. And Goldman sees something a little bit different. Their GDP tracking estimate for the third quarter is not 2.3%, it's 3.2%. And they say the August core PCE index rose by 0.13% month over month, while the year over year rate edged up to 2.68%. Core services, excluding housing, increased 0.16%, and market-based core PCE increased 0.15%. Both personal spending and personal incomes increased 0.2% in August. The savings rate edged down to 4.8% from an upwardly revised 4.9% in July, reflecting yesterday's annual revisions to the national accounts. The goods trade deficit narrowed by more than expected in August. The details of yesterday's durable goods report and this morning's advanced economic indicators report were stronger than our previous GDP tracking assumptions. While the details of the PCE report were slightly softer, on net, we boosted our third quarter GDP tracking estimate by 0.2% to 3.2% quarter over quarter. Our third quarter domestic final sales estimate stands at 2.8%. So very robust data along with softer inflation means Goldilocks, really. And what we're also seeing is credit spreads remain particularly tight, signaling investor confidence in corporates to service their debt and willingness to demand a lower yield for slightly more risk than risk-free bonds. Unless credit spreads actually ramp up in a big way, I think the market's going to continue to do what it's doing and it can handle the current multiple. And as long as we have these tight spreads in the market, expect higher highs, higher lows in the S&P 500. Looking at earnings tomorrow, guys, we have two big names, Paychex and Nike, as well as McCormick Brands. Today we had Carnival and then Levi after the close on Wednesday. So looking at data tomorrow, guys, we have the big thing is going to be the ISM manufacturing data, as well as the JOLTS. And then we have a number of Fed speakers from Bostic, Cook, Barkin, and Collins. And then data gets really heavy from Thursday onwards. And we'll tackle that later on in the week. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.